Hey everyone, today we are going to be looking at exchange rates. All right, what are exchange rates? They are the price of a currency in terms of another currency. That's the only way we can really say what one is worth, is by saying how much it buys of another currency. So for example, this is roughly correct. 1 Australian dollar equals 0.7 US dollars. So $1 buys 70 cents. And that is the exact same thing as saying $1.43 Australian buys 1 US dollar. All right, they are equivalent equations there. All right. Let's have a look at this model. So I want you to draw this nice and big because we're going to make some annotations to it. That's a good way to get the concepts in our head to learn. So draw it nice and big, thinking third to a half of a page, and that'll be good. All right, so this is our model. It's demand and supply. We've seen before. There are a few differences which we'll annotate, all right? So firstly, we don't just have price or P. We've got to have something a bit more detailed here. So we have to say what the currency is and what it is expressed in terms of. So here, I've got the value of a currency can only be expressed in terms of another currency. So you can't just have price of 1 AUD. That's not going to cut it. It has to be price of 1 AUD in another currency. So usually we say US dollars, right? Now, each currency has a 3-letter abbreviation, so we'll get used to some of them. So don't worry about that if that looks weird. All right, what else do we need to know here? The supply of money. So what the supply of Australian dollars is it's those people who have the currency who wish to sell the currency. All right, so you have to have it already, and they have to sell it and buy another currency. All right, and demand for a currency is from those who are normally foreigners that demand the currency. They don't currently own it, but they are demanding it now. All right, so got to keep our head on that. And the equilibrium price, so equilibrium where demand meets supply, that is the exchange rate, right? That's how this is worked out. Okay, a couple of definitions here. We'll use these a lot, so we'll get our heads around them really quickly. A rise in the value of a currency in terms of another currency. What a lot of people already would know is that appreciation refers to a rise in the value of a currency. What we have to say as a definition is in terms of another currency. So it has to be expressed in terms of another currency. I've said that a couple of times. And in a freely floating exchange rate system. Right? That will be important later on in year 12. What that means is it's just determined by the forces of demand and supply. Freely floating exchange rate system. The government isn't involved, right? Okay, let's look at a couple of examples. So appreciation, this pair of shoes, $100 US. So at the current exchange rate, this $1 buying 70 US cents, these shoes cost $143 Australian. After an appreciation, so let's say 1 Australian dollar equals 0.75 US dollars, right? That's an appreciation, increase in the value in terms of another currency. So now the shoes would only cost $133. What this means, key aspect, an appreciating currency makes imports cheaper, right? Key point that we need. And of course, the opposite of that, an appreciating currency makes exports more expensive. So what that means, fewer people will want to buy our exports. They will be more expensive to them. So we sell things like coal. Coal becomes more expensive if our currency appreciates. Okay. What I want us to see here is that what happens to one currency, the opposite has to happen to the other, really. So we'll just go through this example. So we've got this expression, we've seen this already, right? If the Australian dollar appreciates against the US dollar, what that means is that the US dollar must depreciate against the Australian dollar, okay? So if 1 Australian dollar starts to equal 75 US cents, that's an appreciation, you can see that, then the US dollar must depreciate. So therefore, $1 US now only buys $1.33. Used to buy $1.43. So if one currency appreciates against another, the other one must depreciate against it. It has to work that way. Okay, what does that look like in terms of our diagram? Well, there's a little hint about what's going to happen here. So let's say there's increased demand for coal by the US, right? They need to buy our coal. They have to buy our currency first. Our coal miners accept Australian dollars. So the US have to buy Australian dollars and then use those to buy the coal. So that increases demand for Australian dollars, right? Shift out to the right. And so foreigners holding the currency wanting to buy, yes, that's demand. There's an increase in that. And holders of the US dollar, this is the market for US dollars, market for Australian dollars. Holders of US dollars, they hold it and want to sell it. So that's an increase in supply of the currency. So while this happens to the Australian dollar, increase in demand, this happens to the US dollar, increase in supply. Now, there are changes, there are different factors that affect the demand supply of a currency. I don't know why there is a Q there. I tried to come up with a word here. Profits didn't quite work, so I went with profits. All right, so I'll go through each of these. We'll get our heads around them. We'll be good. So remember profits. So profit repatriation. That is when multinational firms send profits home to their shareholders. So for example, Netflix, they make profits, they send them home. What happens? Let's have a look. There's an increased supply of Australian dollars because we give money, or I give money to Netflix Australia, right? So Netflix Australia has all these Australian dollars from all their Australian customers. They want to send that money back to the US. So they have to sell the Australian dollars. They sell them, increase in supply of Australian dollars. And when those profits flow back into the US, increase in demand for US dollars. Okay, there we go. So make sure we get these diagrams down. Just draw all these up. It will help you a lot in the long run, I swear. Okay, remittances. This is another word that we're not super familiar with. It's when people are just sending money between countries, like by households sending money between countries, right? So an example of this is we have many Filipinos come to Australia as workers, and they send or remit income back home to the Philippines. So what's happening here? There's an increase in supply of Australian dollars. These Filipinos in Australia hold Australian dollars and they want to sell them. More people want to sell them. So increase in supply of Australian dollars in the foreign market. That increases the demand for the Filipino currency. I can't remember what that currency is called, but it increases demand for that. So there's an appreciation here of the Filipino currency, depreciation of the Australian currency. Remember that, always opposite of each other. Interest rates. So this happened in 2022. US interest rates went up from 0.25 to 4.5, whereas Australians only went up 0.1 to 3.1. What does that mean? US banks give a relatively higher return, right? So the returns on US savings have gone up a lot compared to the return on Australian savings. So therefore, some consumers, and a significant amount where it does make this difference, consumers prefer to put their money in US banks. So a lot of people will take their money out of Australian banks. They'll increase their supply of Australian dollars and put them into US banks. So to put Australian dollars into US banks, you have to first buy US dollars. So that increases demand for US dollars. There we go. We get this situation. Appreciation US, depreciation Australia. Foreign direct investment. Another term we don't know super well. Foreign direct investment is when a multinational corporation makes a long-term investment in another country. This could be buying a controlling stake in that country. So we say there's a rule of thumb about 10% or more. That makes the investment long-term. They're not just buying shares and speculating. They're buying a large amount of the company. They want some control. Or they could be investing in productive facilities. They might be building a factory or something, right? So bonds, we know them, underwear company. Now, something that has happened with them is they've been bought by a US multinational. So that is foreign direct investment. They've bought 10 or more % of our company. Okay, and US again, Apple have invested heavily in factories in China. That's where all their iPhones and iPads, etc., are put together, as far as I'm aware. It's a bit like Squid Game there. It's a bit weird, but that's what their factory looks like. Okay, so here we've got an example. Bonds is purchased by a US multinational. All right, so who owned bonds before the US? Australians. So the shareholders were Australians. So bonds had to buy it from Australians. So they had to buy Australian dollars, increase in demand for Australian dollars, and they had to sell their US dollars to do that. They had to convert their US dollars to Australian dollars. So that's what happens here. So generally, inward foreign direct investment is going to increase our demand. Outward foreign direct investment, as we can see here with the US, I'm pointing with my fingers, not the mouse, increases supply. Okay, inflation rate. So here, June 2022, US inflation was 9.1%. That's massive. Australian was 6.1%. What that does is it makes US imports relatively less attractive because their prices are going up by more than what our prices are going up. Okay, so that means we're going to buy less imports, of course. So decrease in supply here. We're not sending as much money out to buy US dollars. We're spending that money locally instead. We're not exchanging it. And if we're less supply of Australian dollars, we're not buying as many. Less demand for US dollars. So appreciation of Australian dollar, depreciation of US dollar. I'll just make sure you get that. There we go. Inflation rates again. Here, Australian exports become more attractive as well because our prices aren't going up as much as US prices. So they might start to think, well, wait, the Australian stuff's not getting as expensive. Let's buy theirs instead. So, of course, increase in demand for the Australian dollar. We can see that. We know what's going on there. Increase in supply of US dollar. So we will practice these a lot in class. We're seeing a lot of the same diagrams. That's good. That's going to make it easier. Okay, trade. Changes in demand for exports. So we know to buy our exports, foreigners first need to buy the Australian dollar. So we sell a lot of iron ore. So if there's an increase in demand for iron ore due to the Chinese building a lot of buildings, they need their steel. They get that from iron ore. That's going to increase demand for the Australian dollar because they want to buy more of our iron ore. All right, so increase in demand. And then, of course, that's going to increase their supply of the Chinese currency. Okay. Change in demand for imports. So if suddenly we are able to fly overseas again, when we go and travel elsewhere, all the spending we do is counted as imports. So because we're sending money out of the country, right? We're buying services, but we're sending money out of the country. So that increases our supply of Australian dollars going into the foreign market. And that increases demand. Let's say we go to the US, increases demand for the US dollar, right? So we get that reciprocal change again. Okay. And the last one is speculation. So this is surprisingly large portion of this. Many investors speculate on currency fluctuations to make profit, right? So if they think the Australian dollar will appreciate, you buy it. You increase your demand for the Australian dollar. You buy low. Then if you think the Australian dollar will appreciate, you think the US dollar will depreciate, so you sell high there. Okay, what are some of the macroeconomic effects of appreciation? Firstly, imports are going to become cheaper, right? So what that is going to mean, one thing that's going to mean is lower costs of production for firms. Resources like oil become cheaper, right? So we know what happens there. Increase in SRAS, we get less pressure on inflation, right? So price level will go down. And we've got an increase in real GDP, so that's less unemployment, more growth. Right, that sounds all good. What it also does is that price competition makes domestic firms more efficient because they have to compete more heavily to survive. So they've got to get those efficiencies, and it also increases our standard of living. So we can buy more imports, and that means we can better satisfy some of our needs and wants. And we've got greater choice about how to satisfy them as well. Okay. On the other side of that, exports become more expensive. Now, we'll see, this looks a bit different. We've got the same thing happening. There's an appreciation of the currency. One, we've got SRS going this way. Here, we've got AD going the other way. So what's consistent about the both is we get that lowering of the price level. That's a good thing. But here, if we look at it from this point of view, we've got higher unemployment, lower growth here. So what we have to consider is that the overall effect on growth and unemployment, it depends on the composition of the economy. Is there going to be a greater change in exports than imports? It sort of depends on the elasticity of both of those things as well. So it gets a bit complicated. We don't need to go too far into that. As long as we know that it's a bit ambiguous, then we're good. Okay. And a downside is that some uncompetitive firms, they're going to have to leave the industry. They just won't be able to compete with, now that they have to be that much more efficient, they might not be able to compete. They're going to sell less. They might have to leave the industry. That could be bad news for some firms. Depreciation. All right. We can see where we're going here. Imports become more expensive. So this is just going the other way. SRS, decrease in SRS. We get the upwards pressure on inflation. We get more unemployment. We get less growth. This is not a good situation. We don't like this sort of thing. Domestic firms do become more competitive on price. So a lot of domestic firms can win, right? That's a good thing. That same thing, we get sort of two opposite effects here. Exports become cheaper. That is going to increase aggregate demand. We're going to sell more exports, right? So again, the consistent thing is what happens to the price level. Increased pressure on inflation, but more growth, less unemployment. So again, the overall effect on growth and unemployment depends on the composition of the economy. All right, so this is all we need to know for now on currency. We'll continue more in Year 12 with the government intervention, when the government gets involved in the currency markets. Okay, thank you.